Today, let's talk about something that can suddenly eat up your profits and ruin even the most perfect trading strategy. We're talking about the silent passenger on every trade, slippage. This video will break down one of the most underrated and sneaky forces in trading. Stick around till the end to understand how to stop losing money out of nowhere and boost the accuracy of your system. And hey, give the channel a like and subscribe. Slippage is that moment when you did everything right. Your strategy worked, your entry was spot on, your signal was clean, but somehow the trade closed worse than expected. You thought you'd exit at $50 per share, but it ended up being $49.65. Where did those 35 cents go? That's slippage. And no, it's not because you messed up. It's because the market isn't a math formula. It's a living, breathing system with millions of decisions happening every second. Slippage mostly shows up in two situations. First, high volatility. When the market's jumping up and down like it's on a caffeine overdose, your order just doesn't hit the price you aimed for. Imagine you set a stop loss at $70, but the price crashes right through it, and the next buyer is only at $68. That's the price you'll get, and that $2 gap is your slippage. The second case, low liquidity. That means not enough buyers or sellers. You try to sell 1,000 shares, but at your price, there are only 300 buyers in the order book. The remaining 700 get filled at worse prices, pulling your average way down. Liquidity basically means the depth of the order book, how many buy and sell orders exist at different price levels. The more liquidity, the closer your execution is to what you expected. Take Apple stock, for example. It's in millions of portfolios, gets traded millions of times a day, and your orders get filled instantly with tiny deviations. Now imagine a stock from a small regional bank in the US. Hardly anyone trades it. Buyers and sellers are few and far between. Buy $1,000 worth, and the price jumps 1 or 2%. Try to sell, and it drops 2 or 3% easily. Join our Telegram channel where we post updates on new videos and articles. You'll find the link in the description or pinned comment. Slippage is especially dangerous when you're trading big volumes. One of the biggest myths out there is that slippage only affects newbies or small traders. In reality, the bigger the trade, the more likely you are to move the market yourself, especially in margin trading. If you're going in with double or triple the size, your impact on price is 2 or 3 times stronger, and that means slippage hits even harder. But the problem with slippage isn't just losing money. It runs deeper. It distorts your entire trading picture. You backtest a strategy, it looks amazing, profits flow on paper, but you forgot to factor in slippage. Then you go live, and suddenly the system falls apart. Why? Because the entries and exits aren't the same as in your backtest. 0.5% off on entry, another half on exit, and suddenly your system is break even or even losing money. Now let's say a trader named Tim buys 100 shares at $10, the price climbs to $10.50, and Tim sets a stop at $10.25 to lock in profit. But here's the catch, only 25 shares get bought at that price. The other 75 get sold lower, 50 at $10.20, another 25 at $10.10. The average exit, not $10.25, but closer to $10.18. That's slippage in action. The plan was perfect, but the market had other ideas. It hits hardest during news events. Picture this. A company releases earnings, the market reacts instantly, and in seconds the price drops $3. You plan to sell at 97, but your order executes at 94. The problem is, the market doesn't wait for you. It runs on its own rules, and every order needs a counterparty. To sell, someone has to want to buy. If there's no one, the price keeps falling until someone steps in. That's why pro traders always build slippage into their systems. At the algorithm level, it might be something like current price plus 0.3%. That's the real exit price. Adjustments like this not only protect you from losses, they also keep your system honest. Because the worst thing is not knowing where your drawdown is coming from, and slippage hides in those invisible corners. This also explains why beginners are often surprised. The strategy seemed profitable, but the real results are flat. Why? Because in test environments and demo accounts, slippage barely exists, but in live trading, it's always there. If you're not factoring it in yet, your whole system may be built on sand. Should long-term investors worry about slippage? Not always. If you're buying large ETFs, highly capitalized bonds, or big-name stocks, it won't bother you much. But if you're into exotic assets, small-cap companies, or obscure bonds, slippage is unavoidable, and it can sting. There's also something called positive slippage. For example, you want to buy at $70, but it executes at $68. That's rare, but nice when it happens. Still, don't count on it. Negative slippage happens way more often. Slippage isn't a mistake. It's part of the game. It's a core trait of the market, even if nobody likes to talk about it. You won't see it in brochures, brokers rarely mention it, and even seasoned traders sometimes ignore it. But if you want to build lasting strategies, slippage needs to be a part of your model. So where does the gap come from between what you want and what you actually get? It's baked into how the market works. When you place an order, it goes into the order book. But if it's a market order, it fills at the best available price. If there's not enough volume at your level, the system grabs the next best and the next until it fills your order. It looks like the order book is being eaten, and in practice, that's how prices move against you. We just published a new article on our website. You'll also find free guides on stocks, bonds, and ETFs from beginner to advanced. Go check it out and bookmark it. The lower the liquidity, the longer this staircase of prices, and the bigger your slippage. Sometimes you can't even avoid it with a limit order. You set a price, but the market never gets there, or only part of the order gets filled. So you either miss the trade, get in partially, or wait forever. You can try to protect yourself with stop limits, staged entries, or building positions gradually, but that makes things more complex. A beginner, hyped from a textbook where everything looks like Excel, doesn't get that the real market breathes. It doesn't follow a script. It can get chaotic, especially when it matters most. That example with XYZ stock at $10 shows how sneaky slippage can be. In theory, you know exactly where to set your stop, take profit, and exit. But in real time, the market can throw a curveball, and you won't even realize what just happened. It's not a bug. It's a feature. Slippage is built into the market, just like the spread between bid and ask, and it's important to separate slippage from spread. The spread is the gap between the best bid and best ask, and it's always there. Slippage is how far you drift from your expected fill price. They're related, but not the same. And when volatility spikes, spreads widen, which increases slippage too. In algorithmic trading, slippage is treated with extreme care. Every bot and system must account for it. Otherwise, your data's just not realistic. The irony is that a strategy might look perfect on paper, showing 10% returns in backtesting. But in real life, that 10% disappears into thin air, eaten up by tiny execution delays. If you're a scalper or intraday trader, slippage is your daily companion. On 1 or 2 minute time frames, even a 0.1% deviation can kill your profits. Sometimes, it's better to skip a trade than to get filled badly and take a surprise hit. And if you're using margin, that effect multiplies. Let's say you're leveraged 5-1. That same 0.5% slippage becomes 2.5% of your entire position. And if you're trading daily, that loss can snowball over the month, even if your strategy technically works. Some platforms offer reports on average slippage per instrument. Super helpful, especially if you keep trading the same asset. You can build that into your expected returns. Ignoring it? That's a one-way ticket to unpleasant surprises, especially in high-frequency trading where the margin per trade is razor thin. Here's the big takeaway. In trading, the winner isn't the one who trades the most. It's the one who understands how the market actually works. Slippage is part of that machinery, You can't see it directly, but it impacts your results more than you think. Like water carving rock, slippage quietly erodes your edge, unless you prepare for it. Slippage isn't the enemy. It's part of the race, like tire wear in racing or friction in mechanics. You can't eliminate it completely, but you can manage its impact. Trade smaller sizes, stick to liquid assets, monitor volatility, and always account for slippage in your backtests. Then it won't be a shadow in the corner. It'll be a risk you can handle. Just remember, the market isn't a spreadsheet. It's alive. And every order you place, that's an intervention. The more you intervene, the more likely it is the market responds. Slippage is that response. Be ready for it. Hit that like button and subscribe. If you want to support our content, check the link to our membership platform in the description or the pinned comment.